One of the safest methods to accumulate wealth is investing, particularly if you have a long-term perspective. True victories are achieved with a cautious and steady approach that makes your money work for you, as tempting as it may be to attempt and time the market in the case of short-term gains. Hello everyone, I'm happy to have you all back on my channel. In today's video, we will be discussing the top 5 things you can invest in now for 2023. The best long-term investments will depend on your risk appetite, time horizon until retirement, and the amount of money you can set aside right now. There are many different ways to invest. We'll assist you in selecting the ideal long-term investments for you, whether your goal is to reduce risk with bonds or aim for larger returns with riskier investments, like stocks. To achieve this, we provided a non-scientific breakdown of the top long-term investments for each sort of investor. But before we go any further, I'd love it if you would subscribe to my channel and enable the notification bell so that you may see more exciting content like this. Without further ado, let's get started. 5. Dividend stocks, best suited for retirees seeking stable cash flow or investors seeking quick positive returns. Bond-like recurring payments and larger stock market gain potential are both provided by dividend stocks. A dividend is a percentage of a company's earnings sent to stockholders, often once every 3 months. While dividend stocks are beneficial to all investors, those who need income immediately but have the patience to hold their investments for a long time tend to favor them. The finest long-term stock investments are dividend stocks, which are a good choice. Many investors prefer dividend stocks because of the stability their consistent cash dividends offer. Search for businesses that have consistently grown rather than merely the one with the highest yield right now. Dividends from a wide range of businesses can provide large returns. Because they provide a consistent income in the form of dividends, dividend stocks make good investments. Additionally, if you reinvest those dividends over time, you can take advantage of compound interest to generate earnings that are higher than what you started with. Growth equities are generally riskier investments than dividend-paying stocks because they are typically connected to older corporations. Investors who purchase and hold dividend-paying stocks don't require much active management. All they need to do is establish their initial strategy and routinely reinvest their profits to increase their earnings over time. 4. Real estate, best for investors that prioritize income. If you're seeking a path that will yield better returns than normal, I highly recommend it. Those with a strong investment portfolio and the willingness to put in the time and effort needed to achieve greater returns are often the greatest candidates for real estate investing. For a good reason, real estate has long been regarded as one of the best long-term investments. It's an appealing investment for many since it can deliver consistent income over time and support you in achieving your long-term wealth goals. You shouldn't invest in real estate with money you might need quick access to in the future because it requires a lot of work and capital up front, despite being relatively illiquid. One way to invest in real estate is by purchasing tangible assets. If you want to manage your properties, it can be a highly lucrative source of income, even though it takes a significant upfront investment. Consider real estate-focused investment funds, REITs, similar to ETFs, to get exposure to the real estate market if you wish to invest in it without managing your property. Even though not all real estate investments will develop as quickly as high-growth companies, many will gain value over time. Real estate is a wise strategy to diversify because it is an asset class that performs independently of the stock market. 3. Small-cap stocks. Investors who can handle greater risk are best suited. Successful small-cap investing requires a high level of risk tolerance and thorough company analysis. Investors look to small-cap stocks, which are the shares of small businesses, as a method to profit from those businesses' potential for rapid future growth. Small-cap stocks are riskier than other investment categories because smaller companies typically have less capital and brand recognition than more established corporations. To benefit from the small-cap stock's excellent growth potential, you must have some forethought. It will take time and effort to conduct thorough research on a small-cap firm before investing in it. Since prices can fall during times of market downturn, you'll need to be ready to handle significant price variations. Investing in a small-cap company that expands its clientele and leverages its growth potential can be highly beneficial. However, considering that the company continues to grow, investors with a longer time horizon of at least a few years should anticipate seeing those values rebound along with the market. And if it succeeds, the benefits might be enormous. An organization that began as a small-cap firm is Amazon. Early Amazon stock buyers are undoubtedly experiencing the benefits of their investments today. The description of active accumulators, a behavioral investor type used to identify assured individuals with a higher risk tolerance and aggressive investment strategy, is supported by a picture of a woman. Small-cap stocks are shares of companies having a modest market capitalization. Additionally, you can purchase small-cap companies through exchange-traded funds and mutual funds, ETFs. 2. Cryptocurrency, best for investors who can handle volatility and may be able to profit from a developing asset class. Any virtual currency that uses blockchain technology is referred to as a cryptocurrency, and it is unquestionably more volatile than more conventional investments. Nevertheless, it is becoming a more popular long-term investment strategy among investors. Investors who are afraid of taking risks shouldn't do it. In terms of price index and market capitalization, Bitcoin is the most popular cryptocurrency kind currently accessible. With a market cap of $730 billion in January 2022 and a 40% market share overall, Bitcoin most certainly offers the greatest potential for significant long-term value. Since there are only 21 million Bitcoins in existence, there is also speculation that Bitcoin can act as a hedge against inflation. Dollars, on the other hand, can be printed indefinitely many times. Because of this, it is reasonable to anticipate that Bitcoin will outperform inflation. It's preferable to invest in Bitcoin or any other kind of cryptocurrency as a strategy to further diversify your portfolio, rather than making it your only investment if you're going to do so. The description of independent individualists, a behavioral investor type used to define independent investors with higher risk tolerance, is supported by an image of a happy man. 1. Bond funds through mutual funds or ETFs. For risk-averse investors who wish to diversify their portfolio, it is best. A bond fund, whether it be a mutual fund or exchange-traded fund (ETF), is a collection of bonds from multiple issuers. Depending on the tenure and issuer of the bond, there are various types of bond funds from which to pick. When a bond is issued, the investor receives an annual interest payment in the amount specified. In addition, a professional is paid to actively manage mutual funds by selecting the stocks that make up the fund. Since mutual funds have greater costs than index funds, they may limit your ability to profit. Mutual funds can be a solid high-yield investment if you can find a fund manager with a track record of routinely outperforming the market, but only if you can do so. The profits in this situation could be substantial, but they are not insured. The market underperformance of many actively managed mutual funds makes them significantly riskier than index funds. You will lose money if you decide to pay the higher fees for a mutual fund that ultimately underperforms the market. Bonds are typically a safer investment than stocks, particularly when bought through a fund rather than on an individual basis. This is because bond funds automatically diversify your investment among many bond kinds and issuers, decreasing the impact that a bond default would have on your portfolio. The type of issuer determines the risk of bond funds. Government bonds issued by the federal government are often the safest. Compared to stocks, the overall risk is substantially lower, making it one of the safer long-term investments. Just remember that bond fund security comes at the sacrifice of large investments. Alright, everyone, we have come to the end of today's video. If you enjoyed this video, don't forget to hit like, the subscription button, and the notification bell to get notified when new videos are uploaded from our channel. Do well to share your thoughts in the comments section below. See you in the following video.